Common mistakes in price action trading and how to avoid them. Trading based on price action can be a powerful strategy, but it's not without its pitfalls. Let's explore the 8 most common mistakes traders make and learn how to avoid them. Mistake 1: Overcomplicating analysis. Solution: simplify your approach. Focus on key price levels, support, and resistance areas to identify high probability trading opportunities.
Mistake 2: Relying solely on candlestick patterns. Solution: combine candlestick patterns with other confluence factors, such as trend analysis and volume, to increase the accuracy of your trades.
Mistake 3: Failing to manage risk. Solution: implement proper risk management techniques, including setting stop-loss orders and calculating position sizes based on your risk tolerance. Mistake 4: Ignoring confirmation signals. Solution: wait for confirmation before entering a trade. Look for multiple indicators or price patterns aligning with your analysis. Mistake 5: Letting emotions control your trading. Solution: develop a trading plan and stick to it. Embrace discipline and avoid impulsive decisions driven by fear or greed. Mistake 6: Neglecting market structure. Solution: always analyze the overall market conditions and the specific sector or index your chosen asset belongs to. Understanding market structure provides valuable context for your trades. Mistake 7: Failing to cut losses. Solution: accept that losses are a part of trading. Set a predetermined exit point and stick to it to prevent small losses from turning into substantial ones. Mistake 8: Exiting trades too early. Solution: use trailing stops or take partial profits to let winning trades run while still protecting your capital. Let your profits grow alongside the market momentum. By avoiding these common mistakes, traders can enhance their price action trading strategies and increase their chances of success.